The listings lined up in a row. Josh brings the numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new land. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. Down, the numbers make sense. Jeb shows the vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
All right, guys, happy Wednesday. Happy July 4th week. Josh and I are here to update you on what's happening in the mortgage and real estate world, answer your questions, have some fun while we're doing it. So, Josh, welcome back to another week of us being here together once again.
Jeb, I'm delighted every time I get to hear the song. I mean, I hear new things in the lyrics every time it comes up. I mean, we talk about life. We don't even just talk about just like real estate and stuff. We talk about life. These guys show up every week to hear us talk about life, our life, their life, just life in general.
Exactly. Well, the main reason they're here is to talk about housing. And good news is the housing market is improving out there for buyers. It may not feel like it in all markets, but reality is I'm seeing price reductions. I'm seeing concessions. I'm seeing VA offers get accepted. I'm seeing a lot of things happening in this market that haven't happened in a consistent manner in some time. So those are all good things. We're going to talk about those tonight while we're updating you on what's happening. So as we always do, we like to start with charts, kind of go through, what's driving the housing market, what impacts the market in different facets. But while we're doing that, do us a favor. If you have questions tonight, make sure you're putting them in the chat so that we can answer them as we come out of there. And if you find any value as we're going through tonight, make sure you hit the thumbs up, subscribe to the channel if you haven't done so already. And lastly, there is a scroll on the bottom of the screen. If you want to reach out to Josh or myself and have a conversation, jebsmith.net/start will get you in touch with us. And we can guide you through this tumultuous, crazy market, Josh. This just insane market.
Jeb, just in case you thought it was you and I, we had a long conversation about the different stuff that we see. One of my good buddies, who's a wholesale account executive, he does a ton of business. So works with a lot of people like me doing loans. And he just said last month was one of the craziest, hairiest months. Weird loans, difficult loans, short timelines. Everyone's stressed and unhappy. So it's an interesting market.
I've had every transaction I've had has had some sort of hiccup. And it's not just the buyer. Sometimes it's the seller. There's just like little nuances in every single deal that haven't been there. And they're a little bit more difficult in some ways. And once you get past them, they kind of, they roll on like they should. But it's having the professionals there to be able to navigate them is the key. So With that, start putting your questions in. Let us know where you're watching from. Actually, let us know your favorite fast food tonight. We want to know what your favorite fast food is.
Jeb, I had a better question. I
No.
need help with something.
Well, we need this question answered first. So if they answer this question, we can come back with your question.
When we get like over 100 people, I'll circle back and we'll
All right.
ask. I need some insights on this July
right.
4th weekend.
That's what we're going to do. So it is that time to talk about inventory. So this week looks very similar to last week with regard to how the market is increasing. It is still increasing, though, which is a positive out there for buyers. But we went from 828,890 homes to 831,110 homes. We now have 29% more inventory on the market than this time last year. That gap is narrowing a little bit. We were over 33% at one point. That has now backed off. But the key is last year, same time, we were sitting around 645,000 homes. So that's a big plus for buyers out there looking for the right home, the right opportunity. Orange County, 4,861 homes on the market. This is down slightly, just less than 1% week over week. Huntington Beach saw a small uptick, 2.45%, now sitting at 286 homes. I'm going to ask you a quick question, Josh. Do you think we've seen the peak this year for Huntington Beach already?
Yes, for Huntington Beach, yes.
All right.
For the market as a whole, a bigger sample, I think we're gonna be flat for a while before we start that tail off.
I don't disagree with that at all. So it'll be interesting, but we'll continue to watch it. New listings. So listings came back pretty strong this month. I mean, the goal this year was to have somewhere between 6 and 8 months. That was Logan Modashami, his goal, if you will, for the housing market. We've now seen 3. We've seen 3 weeks this year that have had over 80,000, which again, based on the last handful of years, that's a huge step up. But the question is, what does it look like going forward? This is typically when we see the peak in new listings, as you can see from the chart here. This is kind of the week. July 4th is that week in the year where things kind of hit it here, and then things trickle down with properties coming to the market.
And Jeb, he made the point in one of his articles here recently that dotted line there shows 81,000 new listings last week. He was hoping to get over 80 and hoping to see some months as high as 120. We never got over 90. I don't think the gray line, even back in 2022, ever got over 90, which goes back to say the increase in supply isn't due to a flood of new homes coming to the market. It's just slower uptake, reduced demand with decreased affordability.
Yeah, and if you guys have been listening week over week, we talked about like during the heyday, the crazy time in the market, the great financial crisis. That time there were 250 to 400,000 listings per week coming to the market. So nowhere near that type of market, and we're not going to have that type of market anytime in the near future. So weekly pending sales saw a small uptick this week, 74,130. Last year, somewhere around 66,000. So why do we see a pickup in pending sales? We actually saw a little bit of a drop in rates. Rates did help, came down a little bit. Is that the reason we saw this uptick? I can't say for sure, but my guess is it probably had something to do with a little bit more buyer demand coming in the market. Total weekly pending or total pending sales really for the entire market came in at 396,000. Last year we were at 397. So slightly below, pretty close to where we were last year. Just something to watch. And this is, if you're again following this chart, total pending home sales tend to fall, continue to go down throughout the remaining part of the year. So it looks like we've probably already seen the peak for this year, unless something crazy happens with interest rates. Percent of properties with price reductions sitting at 40%, just kind of flatlining there where we've been the last couple of weeks. And again, I think this is one of those that kind of moves sideways too. And there's a chance that we've seen that peak for the year, unless rates were to move higher, which I don't think that's going to happen. So we have to talk about mortgage rates, where people are sitting, with different rates, that sort of thing. This chart goes all the way back to 2013. The average mortgage rate at that time was somewhere between 5 and 6%. Looks like about 5.3, 5.4%. If you're looking at that chart, we got as low as under 4% there for a little bit, Josh, in 2022. We're now just above that 4%, for probably in a quarter, somewhere in that ballpark. because of people taking higher loans in this environment, that number's kind of skewed up a little bit. But overall, still sitting really, really low compared to just 10 years ago, if you will. Percent of closed in first lien mortgages. So this is something I like to kind of look at. Where are the majority of loans closing, or where are they loan to value wise? Because it gives you a signal if there was distress in the market, how much of the market would actually be impacted. Well, you can see from this chart here, that dark blue is people that have at least 40% equity in their property, at least 40%. And that number is sitting, I don't know, roughly 70% or so there, Josh. Pretty close to it.
72.
But even then, let's just add the 40, the 30, and the 20% equity in the markets there. All of them together, you got at least 20% equity in your property. Takes you up to almost 90%. So almost 90% of properties out there have at least 20% equity in them. So any sort of distress in the market isn't likely to result in foreclosures and the things that a lot of people out there want to see, a crash.
Take those two charts in combination. You've got record low weighted average interest rate with record high levels of equity. So that's why we say, with rents having increased significantly over the last 10 years, doesn't mean that no one can lose their home. It means it is the last resort of what you would do in a financial crisis.
Absolutely. And then again, just kind of following up with the last two charts here, the percent share of loans by borrowers' credit score. So when you're looking at this chart here, the majority of buyers out there, excuse me, Josh.
80 or no, Jeb, 92% of loans, if we throw in, well, that includes the 61, 83% at 660 or above. So we've got about 33% 780 and above, which those people, barring something catastrophic that was sort of unforeseen, that vastly changes their credit history. To get a 780, you can't open your first account now and in 2 years having a 780. So people with long credit histories have shown an excellent payment. 660 to 780 is a very, very wide range. A 660 borrower is very different than a 760 borrower. But when we look at that, you want to get that sub 499. The fact that it's under 1%, that almost matches up. Like, generally for homeowners, you only see a score that low if they've missed mortgage payments and are in delinquency. So it kind of matches up to that 1% delinquency rate or seriously delinquent rate that we've been seeing.
Good stuff. Thanks for jumping in there. My throat.
It's a fun chart. This is a fun chart too.
Yeah. Median price per square foot going over time. Again, this one goes back to 2012 there, Josh, it looks like, and then to current today. Yeah.
And you notice the gap is never all that far apart. And it's normal that we talk about price cuts, or at least if the home price is not cut, it sells for less than what is asked for. It would be logical that sellers would ask for an amount and buyers would like to pay a little bit less. And you see that they move together over time, except for during the pandemic. We had that red line get above a couple times there, right at or above the green line. But the reason why I wanted to throw this one in, Jeb, we talk about a changing market, a shifting market, more power coming to buyers. Look at the gap between, at the top right of the chart, the green line, what the things are listing for, and red line, what they're actually selling for. That's not a massive gap, but it's as big as we've seen going back 13 years.
Yeah. And I think it's very, very important to mention, we always do, that real estate's local, right? So for the better part of a couple of years here in Orange County, homes were selling above the asking price. So that red line would be above that green line here locally. Whereas if you look at this chart, I mean, it only peaked above it for a short period of time, whereas it was a couple of years where it was pretty much like that. So locality dependent for sure, but just pay attention to your market. And then that gap could even be wider in some areas at the moment, just depending on, what's happening in your market.
So this chart, Jeb, showed up in a tweet storm that was very valuable, very informative. Someone else pulled it. I found it through another newsletter that I read, and they were trying to make a very different point with this. But when we look, we've talked often, forget what this is. It's a housing payment, the front end ratio versus the 28% rule. I've been in the business since 1996, late 95, early 96. And at that time, you still had conventional loans, manual underwriting. There was no such thing as automated underwriting. And 28 to 33 was kind of your front end housing ratio. So does that still exist as a thought? Yeah, it does. But in essence, that green line there tracks the percentage of a median household income. So median household income, 28% puts you at 2019. The median home price puts you at 2860. So we do expect, people talk a lot about mean reversion. Home prices have to come down because they're too high. Home prices don't come down because they're too high. Home prices come down because people have to sell and there are not enough buyers to buy them at the current price or the price that they would like. We will likely see mean reversion in the home prices here through incomes continuing to go up, hopefully interest rates moderating, and we may see some moderation in home prices. But I thought it was an interesting chart that if you're out there going, this market sucks and it's unaffordable, this shows you graphically you are correct.
Good stuff.
This is a great chart. I threw a great chart in here, Jeb. That was very informative. So it's jobs week from the economic side, jobs week. No inflation news this week, but lots of job news. So yesterday we got JOLTS job openings, labor turnover survey. There's a bunch of info in there. This has been on a pretty steady downtrend the last few years. For whatever reason, over the last 2 months, and especially this month here, we've seen an uptick in job openings. This is sort of the most up-to-date of the info that comes out in that report, but it's the most volatile. Inside that data, this is the really important stuff here. So you have the hiring rate. The hiring rate is low and stable. So it's not deteriorating. It doesn't mean that job hiring is falling off a cliff, but it's at low levels and dropping. Same thing with the quit rate, low levels and dropping, pretty stable, but at very low levels where we had during COVID. Everyone was quitting their job to go get a better, higher paying job. Or
looks like the quit rate's actually inclining there a little bit.
A tiny bit, but when you look at that, I mean, what are we talking about? They're between 1.9
it's
to
not
maybe
huge,
2.0, 2.1. These are all fairly stable. We're not seeing a big shift. We're not seeing a big change in this data. And then the last one there is the layoff rate. The layoff rate is ticking up, but very minimally, just like we're talking about in the quit rate. They're both increasing, but not a whole lot to talk about. This morning, Jeb, we got the shocker to a degree. The 80, don't go, hey, listen, Jeb, we laughed and made childish jokes last time and we got in trouble. We had bad comments about that. So let's not do that again. But they were expecting, what was the number, Jeb? They wanted like 110,000, or we're expecting like 110,000 or 90,000. And we got minus 33,000 jobs created per ADP. It's the lowest since we had a negative report in early 2023. So in early 2023, did the world fall off its axis? Did everything implode? It did not. So this could be 1 month. It could be an aberration, but it could be the sign of things to come. So tomorrow, Jeb, we get the big one, which is the actual non-farm payrolls. It's been trending down. If we draw a trend line here, you see it's volatile, but trending down. The forecast is for 110,000 new jobs created. The previous was 139. So definitely decelerating. We're seeing monthly downward revisions. All of last year and most of the year before that, it was grossly overstated, and long-term gets revised way downwards. I threw this one in here, Jeb, because this is important. So if we look and say they're forecasting 110,000 jobs, last month we had right around 132, 135, something like that. This is the break-even job level, break-even level for job creation. So it says in the last year and a half, we went from needing 165,000 jobs per month to keep the unemployment rate steady to now we only need 87. So if we get 110, you only need 87, you could see the unemployment rate drop. The guy who puts this data together is very trustworthy. I don't think he's manipulating the data. I think it's a little bit crazy to think that it is that low in that short of a time frame. And you might be saying, why? Why would it change? The change in immigration. We don't have wide open borders with lots of people coming in. Those people, when they get jobs, they get counted in job creation and the unemployment rate. And then we have an aging population. The silver hairs are retiring. So we have a smaller workforce and there's less job creations needed to keep unemployment steady. So this kind of shows you what it looks like over time. As recently as December of 2024, we had 323,000 jobs created and it was around 100, but it's definitely been trending down. So something to keep an eye on, probably an explanation why these weak jobs reports haven't really led to like hey, we're going to be immediately in a recession. This very anecdotal here, but Google search trends for unemployment. This only goes back to January of this year. So we saw in late January, we saw a big spike, saw another spike in April, another one in May, and then just all of those search terms, searching for apply for unemployment benefits, filing for unemployment claim, filing for unemployment insurance. All of those are increasing. So something to watch over time. This one, Jeb, I thought was important. Also, possibly a canary in the coal mine. This shows the unemployment rates. Unemployment is very low. We're at the entire labor force 4.2. This shows it at 3.98. So they're pulling it from the Fed. I'm wondering which measure they're at there, but 3.98. And for college graduates, it's even lower, 2.66%. But other college graduates, the orange line is recent college graduates, they're at 5.8%. So number of things could be happening there. They could be feeling the impacts of AI. A lot of entry-level jobs that recent college graduates would be filling have been automated. So something to bear in mind, because generally recent graduates fare very well and have a similar unemployment rate to everyone else. In terms of the picture here on GDP, the economy is slowing. The blue chip consensus hasn't been updated since early June, and it was up towards 2%. We're seeing the Atlanta Fed's GDP now sort of converging downwards. We're going to see somewhere probably right at 2 or just below 2. That blue chip estimate is probably what it will come out at when we get the numbers going forward. We like to watch inflation. We didn't get any inflation numbers this week, so it's good to look back at the trueflation. Down to 2.03. A week ago, it was at 2.18. Yesterday at 2.07. So again, still not seeing the Fed's feared surge of inflation due to tariffs. In looking at that, what's it doing for mortgage rates? That right channel, that channel on the orange channel on the right side there coming downwards shows us we've made, as of yesterday, we were down about 0.3% over the last 6 weeks. We gave back a little less than 0.1%. So we're about 0.3% lower than we were 6 weeks ago. The important thing for those of you in the market, shopping, putting something under contract, thinking, do I need to lock? Do I need to be worried about this? We are beneath all of those moving averages, the little rainbow of lines there. We're underneath the 20, the 50, the 100, the 200. So as long as we're underneath all of those, don't get too worried about rates spiking on us. As long as we stay below that top orange line, also don't get too worried about that. So Mortgage News Daily, what are they reporting? Up 0.06 over 1 day, down 0.06 over the last week, down 0.25% over the last month, down 0.4% over the last year, leaving us right about 6 3/4 for well-qualified borrowers. Really well-qualified borrowers are going to be doing a little bit better than that. If you have a bad credit score, not much of a down payment, could be a little bit higher. And the government stuff, FHA and VA, right around 6 1/4. But again, hopefully you're doing a little bit better than that.
All right, good stuff. Thanks for that, Josh. Let's see what we got here. So let's go to this one. So this is the time we start looking into what's happening here with regard to comments and questions and that sort of thing. We'll start putting them on the screen. But Josh, our podcast this week on the educated home buyer. Well, actually, we recorded one today, which was our second half of the year forecast. It's going to surprise some of you. Josh and I don't entirely agree on the direction that that's headed, but it's not going to be released this Monday. It's going to be the following Monday because we're about 10 days out from the episode releasing. We'll mention it again next week, but it's definitely something to pay attention to. Again, there's some things changing in the market, and we're seeing things a little bit differently. So, yeah, but just wanted to throw that out there. And this week's episode, Josh, what did we talk about? We talked about we talked about housing supply and its impact on the housing market. So if you want to know how supply is impacting things, how it's likely to impact things, make sure you check out that episode on theeducatedhomebuyer.com or the YouTube site or Spotify or Apple, all that good stuff. Anyway, here we go. All right. We got Kevin Hawthorne, Josh. We haven't seen that name in a long time.
He watches a lot of videos. He has not been watching ours recently. So we're glad to see you back, Kevin.
All right. So I asked earlier, what's your favorite fast food? We've got a Whataburger in here from Dixon.
So Dixon's in Texas. That's a Texan claim. Only Texans claim Whataburger as being the best.
I agree with that.
It's a widely held belief among Texans, though. They'll go to their grave claiming that.
What does
this is an Inland Empire, Southern California claim. Baker's is only
Baker's. What is that?
It's like a hamburger shop. Like it's not mom and pop. It's bigger than that. There's a lot of them. Pop Keys, if you're around, tell us exactly what Baker's is. It's a burger stand in the Inland Empire.
All right. I'm not mad at it. We got Waffle House and actually gave us the food choice from there, a BLT from the Waffle House. So, a good BLT is hard to beat. I mean,
do they make it with waffles? Is it waffles with bacon in the middle?
I could get behind that, but
I could get behind that.
It's all good. Is that all we got? food wise.
Well, but you notice here, Julie is from Atlanta, Georgia.
In-N-Out.
So also again, regional. Waffle House, Georgia.
In-N-Out. Oh, a lot of these are regional. In-N-Out. I mean, obviously, well, In-N-Out now is no longer so regional, I guess. I mean, there's some locations in Texas and Tennessee and some other spots, but
So
anyhow.
how about this? For those of you who have had in the past and remember and enjoy real California In-N-Out, now that you get it in other parts of the country, do you also agree that it's not quite right? They're totally vertically integrated. So when they go further out, they have to get different farms, different bakeries, and it's just a little off. Just a little off. It's not right.
There you go. So this question came in from Caesar, or a comment. Just wanted to stop by and say thanks to Josh. Oh, it's a comment. House is coming along with lots of work, and I'm excited to build my dream home and yard. Only way it can get better is rates drop, but not counting on it. So we'll appreciate you dropping here and letting us know. We got that
Caesar
there.
and his wife looked at a lot of turnkey homes, and they ended up with one that needed a bunch of work. He actually follows up here, Jeb, to say 16 trips to the dump later in yard work. They have a huge yard. Cool older house that was a little bit dated. I've seen some pics so far of the update. They're making some nice progress on it.
All right, and then here we have Jay putting an offer in on June 16th under asking. They accepted, so congrats to you. Appreciate you being here still, even though your offer is accepted. So we appreciate you for that. All right, Josh, what do we got here? I tried to go a little bit different on the screen so that I could fit more on it, and none. The words are even smaller than they were before. This is crazy.
Good thing you have turbo eyes. You can handle that.
I guess. We got we got clowns in the comments again. Clowns are back, Josh. The clowns are back.
They're fighting. Unfortunately, they're fighting each other in the comments.
Let's see here.
We don't have a lot of questions yet. We got a
don't
lot of
have
comments.
A lot of questions. Yeah, a lot of comments. People just going back to themselves. Here we go. All right. So you don't need us. This is good. All right, Josh. Well, ask your question. What did you want to ask earlier? You needed some help with something.
We're considering running out tomorrow, the day before 4th of July, the greatest biking holiday of the year, and getting e-bikes.
Oof.
I know which bike I want, but
Which bike do you want?
My wife doesn't know. I want it. Crew has a 29-inch electric BMX cruiser. I said, so I'm in. That's all I need. But my wife wants a beach cruiser. And we need one of the ones that you can unlock to go 35 mile an hour because we want to die on our electric bikes.
Well, here's what I'll tell you is I shit on e-bikes for the last couple of years. In fact, we won't let our kids have them. We won't let them ride.
Well, that's smart. That's smart.
So that's part of it. But my wife has a heart condition and can no longer really get her heart rate up. And so one of the things is we like to ride bikes down to the beach and go to the different restaurants and stuff like that and so on and so forth. So I said a couple of weeks ago, I'm like, I'm going to buy her a bike. So I went and bought her a bike from Rad Power Bikes down to, they have a store downtown, has the little seat on the back where we can fit our youngest and we can cruise and do the whole thing. Well, I get it home and she, first off, she felt like it was too unstable for her. So I ended up with an electric bike, Josh. So now I have an electric bike. And here's what I'll say. This is like the lowest level. So the max it goes is like 20 miles an hour, which is by far feels like you're flying.
It's plenty fast enough. It's faster than you're going to pedal yourself.
But I will say I've crapped on it for a long time. And what would have taken me, maybe 20 minutes to get down to one spot took me about 5. And I was like, you know what? I can get behind this. So, the headwind in Huntington Beach, when it comes.
Oh, it's no joke.
Oh, it sucks. It sucks. Especially if you had a drink or two and then you're trying to get back. No bueno. The electric bike, you don't feel a thing. So I think you should do it.
I want one. I've selected mine. I'm happy with my choice. I got to find a sweet beach cruiser that will go 35 because my bike will go 35. So my wife has to be able to keep up. But we do have.
I don't know where you're going to go 35 on this thing. You're going to kill somebody.
I'm going to rip. I'm just going to rip. That's me.
You are the problem.
I am the problem. Just remember that. We do have a good question though. Mike Moore, In-N-Out fan, Mike Moore pipes in to say, in this market, is it wrong to ask for a seller to pay the cost? And the funny thing is, we had a couple of really good comments here from listeners. Area dependent, but I say no. Depends where you're at. Some markets are still going up. Very good questions. Longtime listeners, apparently. But how do you advise someone if they're asking if they should ask the seller to pay for their costs or not?
It depends on the cost. Depends on what you're asking, right? So seller should always pay standard cost. I mean, pretty much in every market, right? Their portion of the escrow fee, title, insurance, that sort of thing. Those are all things that I think the seller should be responsible for, on top of HOA docs, that sort of thing. I think you're probably asked, and compensation for the most part. I mean, that's been something that the Fed did a survey a couple weeks ago at this point, maybe a couple months ago, and basically found out that the whole compensation thing that was out there has had very little impact on the market. Most sellers are still paying it, maybe slightly lower compensation than what was actually happening before, but most sellers are still paying it. So I feel like you should definitely ask for that, but I don't think there's anything wrong with either asking for, depending, again, how long has the home been on how long has the home been on the market? What's the competition look like? But say you're the only offer, home's been on the market a little bit. I think you can ask for money towards closing costs to buy down the rate. I think you can ask for a reduction in the price. I think you can get a little bit more aggressive with your offer. But again, area specific.
One of the crazy things that I get, Jeb, and this actually came up this week with a buyer here, and she's actually buying in Huntington. She's from Texas, coming back this way. That doesn't happen often. They usually go the other way. They flee Huntington to get to Texas. But she says, hey, I want $10,000 to buy my rate down. I said, okay, cool. Were you looking at a temporary buy down, or were you looking at a permanent buy down? I don't know. What's the difference? So there's a lot of this out there where people just don't know. I mean, it's not your fault. You don't deal with it every day. So we probably should do an entire episode on it, Jeb, because it was enlightening for her.
I thought we did. Did we not do that?
Maybe we did, but no one listens to it apparently, because I still get these questions all the time of when would you use one versus the other? What's the benefit? What is your mindset? Because it's one of these things what I hear all the time. Listeners will call say, hey, I'm talking to this loan officer. He really thinks I should do a 2-1 buy down. If you talk to a lender who really thinks you should do a 2-1 buy down, you should go find another lender. I shouldn't have a strong opinion about what you should do. I should be able to ask you about your situation, help you get clarity on that, and understand the pros and cons of permanent buy down, temporary buy down, or just getting a lower price, or using the money. And so in this lady's instance, it's about $10,000. She could do a 2-1 buy down. She could get a 5/8 lower interest rate permanently. She could cover almost all of her closing costs, or we could just say, forget all this, let's cut the price $10,000. So important to know all of those things are options when you're in a market where buyers have a little bit of power and can negotiate.
And you said something, Josh, that I want to touch on is that, and I want to phrase it a little bit different way, that a lot of times agents, mortgage, quote unquote, professionals get in the way of their own transactions and give opinions and advice where it's not needed, necessary, and completely unethical in many ways, like telling somebody what they should do versus giving people the information and the guidance and answer questions and let people make their own decision, right? There's the idea out there that you should be doing this when everybody's situation is a little bit different. Maybe I shouldn't be doing that. Maybe instead of the credit, I should be asking for a reduction in the purchase price. Maybe I should be asking for both, but don't let somebody tell you what you should be doing. Ask the questions that you feel like are important to you. Let somebody give you the answers. And then at the end of the day, make your own decisions based off the knowledge and expertise that you've gained through that process. Now, I'm going to do a shameless plug here. Josh and I do a really good job at this, the guidance part. That's why we both have over 100 5-star reviews, people constantly leaving reviews. Many of you have purchased homes. You still show up here. And for that, we're grateful. So if we could be of assistance to you in any way, use that link in the description, jebsmith.net/start, and you can get in touch with us and we can guide you through that process.
Jeb, speaking of those 5-star reviews, I got a first today from a listener to the show that we closed on Monday. He gave me a 5-star review today, 100% in Spanish. I don't speak Spanish. Thankfully, Google translated it for me, and it was one of the best reviews I've ever received. So, Benny, thank you and congratulations.
Here's what I'll second that. You sent it to me. I threw it into GPT. I didn't even go Google Translate. I just threw a picture into GPT and said, can you translate this? And dude, perfect. Like it took a second. And I was like,
immediately. Well, the best part is unlike some people, Google knows I don't speak Spanish. So when it came through translated, and it said translated by Google. It knows.
Oh, wow. Look at that.
Gringo only speaks English.
All right, here we go. So Bleed Green left us a $5 super chat. So thank you for that. Appreciate you. Says, been 3 months, middle FICO still 651 with your recommendations on my credit. Supposed to close in October. Hope it can go up soon. So Josh, any thoughts on that?
In general, so we do refer a company called My Credit Guy. Most credit restoration, credit repair companies out there are a scam. Even with My Credit Guy,
Agreed.
they are not going to do anything that you cannot do for yourself. What they're going to do is give you a plan. Here's what needs to be done. Here's what we would charge to do it. Here's if you don't want to pay us to do it, you should do this yourself. And most importantly, there's always a timeline with everything. Timeline of 3 months is about as short as I've ever seen. They usually quote 4 to 6 months for ones in terms of getting a bump. And the most important thing is you got to do what they tell you to do. If not, don't pay them. Don't pay them if you're not going to follow their advice. I've seen people that we've referred over there. I get monthly updates, and 2 years in, they've been paying $120 or whatever it is per month for a couple for 2 years, and they've run up their credit cards higher. They have more collections, and they haven't fixed anything. Save your money if that's you. So know yourself on the way in as to whether it makes sense. But in the next 4 to 6 months, which gets you before October, hopefully we're going to see some nice improvement for you there.
All right. Got a question here. How does having a home equity line of credit impact your DTI, Josh?
Well, it's going, so if you have it, it's going to report, and it's going to report a monthly payment. All we have to do is count that monthly payment. I mean, the reality is some of the HELOCs now only have like a 3-year draw period and then a 27-year repayment period. We don't even know. You could be 20 months into this, and in 4 more months or 16 more months, you're going to be looking at an increase where it goes to fully amortizing. We're going to look at it like all of your other bills, what shows up on the credit report, and we're going to count that against you in your DTI.
Okay. So what if I haven't drawn on my home equity line of credit, but it shows on my credit, just shows a zero balance? I'm not getting charged at all?
There's nothing there. It's zero. Right. Now, say the same question. I got a $500,000 line of credit on my house. I want to take 200 grand and buy a lake house. Cool. We have to source that and show where it's coming from. Now I need to get your home equity line of credit agreement that says, how do we calculate the payment? Because that 200 is going to come from that account, either get wired or you're going to write a check on the account, however, and it shows up into that new escrow. So it can end up into your DTI.
This is one of those comments that I feel like is stupid. And I'm sorry for saying that.
No,
and I hate hearing
since you're a realtor, since you're a realtor, can I answer it for you? Because I'm not biased here in this one.
Sure. But I was giving a strong opinion because I hate when people think people do shit just for money.
No, well, if it was just for money, what are we talking about? Median home price in the United States is $400,000. If you somehow convince someone to overpay by 10%, that's $40,000. A 2.5% commission, you made $1,000. You risk losing a sale. You risk pissing off a client. You risk being considered unethical, getting a bad reputation, pissing off other realtors. But we're not generally talking about $40,000. What we're talking about, they want you to pay an extra $10,000. Well, an extra $10,000 to make $250. Realtors make money on doing a volume of sales, not making each sale the tiniest bit bigger.
So let me ask you a question. Because I mean, this is the reality. If I have a home sitting on the market and it's not selling, would it not be smart of me to try to get the seller to reduce the price in order to sell the home?
Stop being logical.
Because stop
using logic.
No, because based on that comment, I wouldn't want a price reduction. I would want to keep the price there so that I could maximize my commission. No, like, listen, your goal, my goal as a real estate agent is to help clients, make them happy with the process so that they refer their friends and family to me so that I can sell more houses, right? How do I do that? I do that by helping them maximize the price, help them maximize the time, all of those things. Do all agents work like that? No, but I think phrasing it as like, that's how agents work is, it's ridiculous.
Well, listen, we're being respectful, TM. If we were here and you could actually have context, but falls up. It depends on the home. The last few years, homes haven't been sitting. And if we're in a multiple bidding situation where there's 20 offers on a home, do you know what the realtor's job is? Is to get the highest price for the seller.
Sure.
And the buyer's agent's job is to get the lowest price for the buyer. That's what everyone's job is. That's what you have representation for. It is not their job to go, hey guys, you know what? The market's up. These are nice people. They should maybe pay a little bit less for this. The market determines the value of the homes. Realtors do not. This is a silly debate.
It drives me, but another thing that drives, like, well, let's just go off on like a tangent here, Josh, and talk about all the things that drive us crazy. If you're a seller, what is your goal with the house? Like, all buyers want to complain. Well, guys are just jacking up the price. Listen, I don't pick the price. I recommend what I think the home should sell for based on comparables. The seller picks the price, and ultimately the seller picks the deal that they want to work with, maybe based on recommendations from me, but guidance and all of those things. But at the end of the day, one of the conversations I have with clients is what's most important to you in this process. 9 times out of 10, maximizing the price. That's it. Sometimes people say, I want my home to go to a nice family, or, this is what's important to me. That's rare. It's price. And so our job as agents is to create, exposure, demand around a property, so that ultimately they get a higher price. So if you are a seller, put yourself in those shoes. Like, you want the highest price. So don't get mad because the price goes up. Then that's obviously not that right property for you. Just find another one. Right. Or change and wait for the right market.
There's bad apples in every group. So any group, you take 100 realtors, are there a couple greedy ones, or a couple that are unethical, a couple going to do some crazy things? 100%, just like in any other group. What I can say is, in the last week, 2 purchase agreements come in, and I look, because now we have to see who's paying the commission. So I pay more attention to what is the commission and who's paying it. Both of them were agents who've done multiple transactions with these buyers, and both of them took a discount. Hey, this is a great client. They take a lot of they've brought me personal business, referred me personal business. I'm going to take good care of them, because it's all about doing volume. The idea that there's some tiny little bit of extra commission in any one transaction that would override a prudent professional's approach to the business is insane.
Do you know how much commission I've given up in my entire career, Josh? I mean, I think about that often. Like, if I never gave away things or helped clients with certain things and repairs, and dude, I would make a lot more money. The reality is, I want happy clients. I want people to walk away feeling like they got a good deal. They got represented well. Nevertheless, we're off that tangent, but we don't have a lot of questions, so I figure we just go down it.
Well, here, let's go back. Mike said something. I have a HELOC at 14%, 68,000 maxed, loan maxed, but home is 4.75. I don't know if there was a question there, but yeah, if you've borrowed the full amount, that payment is going to report on your
14%.
We probably should have a conversation about if that could be improved. At one point, Jeb, when we had both the margins that most lenders were offering were higher, and the Fed funds rate, so the prime rate, was higher itself, we saw a lot of them in that 12, 12 and a half, 13. 14's on the high end of it. He might be rounding up.
I hope so.
And he may not have looked at it after closing the loan, and when we got a point of Fed cuts last year.
All right, that's fair. That's fair. Okay, question time, guys. Come in with questions if you have them. It's that time. If you find any value, make sure you hit the thumbs up. Consider subscribing to the channel. If you're somebody that's a seller, I started another channel, How to Sell Your Home. It's actually doing fairly well, taking off almost to 2,000 subscribers in just a couple of months here. But it is specifically talking to sellers. I don't address buyers in the slightest. So if it's very, very specific to a certain demographic, not demographic, certain psychographic.
Why didn't you call it the educated home seller, Jeb?
I could have. You could have started a separate podcast for that.
An umbrella brand of the educated.
We could. I thought How to Sell a Home was really simple. It just got to the point. Like, this is what you do.
All right.
But anyhow, that's enough about that. All right. Well, Josh, what do you want to talk about?
The funny thing is, one of these questions triggered something that I did want to say, and I do not remember exactly what it was. Well, here, I'm going to go back. Bleed Green 215 says, please do a video on a permanent rate buy down and a 2-1 with 29. What's with 29? Let us know what you're actually wanting there, but I'll go back, and if we get another question here, Jeb, while you're answering it,
I think we have an episode on buy downs, but I could be wrong, and I think it might be blended in with seller credits to some degree.
Okay,
but
everything's a trade-off. So, like, it's not free money, because it's coming from the seller. If the seller is willing to give you that, they would be willing to give you a price reduction. They would be willing to do any number of things. So just know, what I hear a lot of is both realtors and lenders pitching this like it's free money. It's not free money. It's actually someone subsidizing your mortgage. A temporary buy down is someone subsidizing your mortgage for a brief period of time. So you're sort of eating the seeds being what would have otherwise been equity in the home if you had just taken a lower purchase price and a higher monthly payment and made your own payment and waited out the opportunity to refinance that hopefully will come at some point in the future.
I like the way you explain that. That's the way to explain it. Josh, I don't see a lot of questions here, my friend. So we can do one of two things. We can cut the episode now. We could talk about something separate, or
we can shoot off fireworks. We can have a fireworks war.
Here's the thing. I'm actually doing a fireworks stand tomorrow as a volunteer. See, these are the things they don't tell you when you're a parent. When you're a parent and you pay for sports, you think, I'm just paying for the sport. I'm going to go watch the sport. No. Guess what? They now need coaches because nobody's willing to coach. So then you become a coach. And then when you don't coach those sports, they say, hey, we need volunteers. And then you volunteer. And then they need somebody to sponsor the team. And so then you're sponsoring teams. Hey, dude, I mean, even club soccer, I'm out there volunteering. I'm painting the field. Like, what are we doing? I thought I was paying for this stuff. Dude, they just bleed you dry, Josh. Bleed you dry.
It's like a whole nother level though. Like when we were kids 150 years ago, it was like, here's a ball, go play. And now it's like we got to make the whole thing like it's a Sunday night NBA telecast.
That's exactly what it is. We're going to just click on this. I don't even know what it says. Raul says, recently went into contract contingent upon seller replacement. Turns out the seller does not have money for EMD to get into his new contract. The agent ends up loaning seller EMD to continue the deal. That, I think, could be
problematic.
Could be problematic, especially if they're doing a loan, because guess what? They need to source that money. And so when Josh asked the buyer, hey, your EMD, where did that money come from? And they have to say, well, my agent, unless that agent is a friend, a family member, somebody that's close ties, I'm not sure that can be done.
It comes down to the type of loan. Is the money getting paid back? How exactly what it was done? Hopefully that they asked the lenders involved and gave them all the details up front so that you could get the correct answer on that one. Jeb, go ahead. I was going to say, Dixon's back here, and this is funny. So he says, we should do a video for engineers buying houses and their spreadsheets. So Dixon's an engineer. And it didn't take long because this is a very common practice among engineers. Everything is just a spreadsheet, right? So he had Dixon. You're still here. Tell us how many lenders you had spoken with, and it kind of goes back to I need to shop for my loan, right? Well, if you only talk to one person, it could be the greatest deal on the planet. It could be the worst. You don't know. So at least when you talk to two, you go, well, did I like one of them better? Did I click better with one of them? So Dixon had 8. He had 8 in his spreadsheet. 8 is too much, even for an engineer. So 2, 3, once we start getting into 4 or 5, what I have found is that people get really confused because they've been told so many things. And generally, when you're making that many outbound calls, you're going to get to 1 or 2 call center loan officers. I was just back with one of our lenders in a group mastermind of 50 top producing loan officers from around the country. And we're talking about some things. And one of the loan officers says, you should teach us. I would like to hear more about buying leads. And a couple of guys in the back of the room who had come up through call center stood up and said, here's the reality of it. You do not want that. And I won't bore you with why they said a loan officer doesn't want to do that. But they basically said, we have a sales pitch. We have a rebuttal for anything you can say. They don't have an answer. They're not educating you. They are going about pitching you and selling you to get back to them. So the more people that you talk to, the more sale pitches you get and the more confused you get. You want someone who's asking you, first of all, listening. So whether someone asks questions or not, they should just listen. Hopefully you're telling them what you want, but listening and giving you feedback. Am I understanding your goals? Does that sound right? Any other questions that you have? And it's not what you're going to get from most places. I had someone call in the other day, listener to the show, Jeb, wanted to know about potentially refinancing a property out in Texas and said he'd already talked to someone. I said, okay. And he gives me the rate and I started asking some questions. I go, is this property owner occupied? No, my kids live in it. It's an investment property. It's like, okay. So the kids living in it could, there's an exception where it can be done owner occupied. But I just asked, I said, did the person that you talked to ever ask about the occupancy? No, they never asked. quoted a loan without asking about the occupancy. So you get things like that where they go right into their pitch. They're giving you numbers. They gave him a number that even on an owner occupied property would have been multiple points. So the rate sounded great, but long digression, but Dixon, I totally understand. There are people who want to educate themselves, want to make comparisons, and want to put themselves in the best spot. Well, once you get to a certain point, you're just going to make it more difficult on yourself to make a good decision.
All right. And if Josh can be of assistance in that process, there's a link there at the bottom, jebsmith.net/start. So I'm going to take a minute here. We don't have a lot of questions. I'm going to give you some advice as a real estate agent, writing offers for buyers. One of the things that we do in every market is we try to make the offer look appealing. Even in the market now, you're not competing against 20 other people in most cases. In LA, I was last week on an offer, which we can talk about here briefly in a moment. But you're still presenting the best offer possible, even in slower environments, because you want the agent on the other side to not only, you want them to respect how it was written in the offer and so on and so forth, but you want them to be able to sell that to their client, right? And so by doing that, sometimes we shorten contingency timeframes. Yes, even this environment, we're not waiving things, but we're still shortening things again because we're trying to appear like we want to work together, and we want you to pick us and not have to go back and forth on a bunch of counters. But nevertheless, in doing so, one of those things that we do is sometimes we shorten the closing date, we shorten contingency timeframes, we do different things. But I never ever do that without having a conversation with the lender before I do that to actually make sure that they can meet those timeframes. So if we're shortening, like for example, we wrote an offer on a property in LA last week. Before we wrote that, I reached out to their mortgage professional, and she said they could do the loan in 17 days. Perfect. We wrote it into the contract. I didn't write it for 17 days, and then she find out after the offer was accepted that it was in 17 days. That's a problem. I also shorten contingency timeframes because I want, again, to appear like, a strong offer. I don't shorten those without confirming, hey, lender, can you get the appraisal? Can you get the loan approval done within 10 days, within 7 days? Because we want to be aggressive here. Josh says, yes, we write it. Josh says, no, you know what? I could probably do 12 or maybe give me, this. Okay, that's what we do. And the reason I say that is because I'm hearing a lot of people having issues, having to extend closing dates, deals falling apart because these things weren't structured correctly up front. So as a buyer, if your agent is recommending doing this, ask your agent, have you had a conversation with my lender? How do you know we can meet these timeframes? I'll step off the soapbox.
And Jeb, I experienced the flip side of this. We closed literally last Friday, and it was 8 days late. And you go, Josh, you dropped the ball. You closed 8 days late. My buyer was selling a house. They were putting roughly 50% down on their new purchase. They have 750 credit scores. We knew the money was coming from here, going to there. The realtor, without talking to me, concluded that it would be great to write a 13-day escrow so that the buyer could concurrently close and go from one house to the next. Never asked. I got the contract a day later, so now we're 12 days. There's 2 weekends in the middle, so there's 4 days gone. We're now down to 8 days. We had the Juneteenth holiday, which most lenders were shut down and certainly not doing so I had 7 days to do the loan. Well, it turns out the borrower had a business who they had a couple down years. We had to do a bank statement loan. With that bank statement loan, we almost got it in there 13 days, Jeb. We were one condition shy of clear to close, and that lender required a CPA letter that our borrower's CPA was unwilling to give, which is not uncommon. We were able to put it together in that next 9 days and got it closed in 21 days, which is still fast, but it was stressful for everyone. Thankfully, I've worked with that buyer before. They know me. We told them day one when I got that contract, we're going to haul ass, but this is going to be problematic. So you just want to make sure everyone's talking and on the same page. A lot of times when you guys are out and you find a realtor, many of you that I deal with, different parts of the country, it's not a realtor that I regularly work with. First thing I ask is make an introduction. Let's talk. I'm shocked at sometimes there's agents that want the borrower, the buyer to be a go-between versus getting on the phone with me and being on the same page with everything.
Good stuff. Good stuff. So I mentioned I would talk about a deal that I had in LA just for conversation here. Again, no question. So it's the comment show tonight.
It's
So
just talking.
yeah. So again, most markets are soft. This particular property was in LA. Have some clients moving from here, selling their house and buying up in that market. And this particular home was priced at $1,250,000-ish. And they called me and said, "Hey, we're interested in it," so on and so forth. So I said, "Hey, let me do some research on the property and get back to you with my thoughts." Well, I saw that they had it listed about a month and a half prior for 1.6, but it 0 days on the market. So they literally put it on the market at 1.6 and then pulled it off. And I thought that's kind of weird. And so when my clients went through the open house, they happened to talk to the agent, and the agent said, "Hey, we already have like 20 offers on the property, and the it's going to sell substantially over the asking price." And I said, "Okay, substantial. That to me, that's something we need to pay attention to." So my clients came back and wanted to make an offer at $1,375,000, and I think properties listed at $1,250,000, $1,375,000. Is $125,000 substantial? In my eyes, not really. Like, I think it's going to go much higher than that. Well, after calling the agent and having a conversation, I said, "Hey, listen, this is where my clients are at. This is where your purchase price is. You have 20 offers. I would imagine you're really up there in price." And I go, "You had it listed at 1.6 a month ago and you didn't come to market." And she goes, "Here's the deal. Back then, when I put it on the market, the environment was changing, right? There were tariffs coming in. There was uncertainty between, what was happening with Trump and just all of these different things, protest in LA, like all of these things were playing a part." And she goes, "We were just unsettled. Like, we didn't know." She goes, "I was having conversations with other agents and they were like, our homes are sitting, like they're not moving." And so the last thing we wanted to do was overprice the home. We thought 1.6 was about the right number for the property. And I looked it up and I was like, hell, I could find comps to support 1.9 is what I told my client. So I was like, no world in which this thing sells for $1,375,000. But nevertheless, after having that conversation, it was basically like, listen, the offers are going to come in somewhere between 1.6 and 1.750. It was her thoughts based on what she had already had. But it just shows you, like, out there, when you see something like that, it was listed at 1.6. Now it's $1,250,000. It drew a bunch of attention, ended up selling for a lot higher. So people look at that and go, now it's a success story. Well, this home sold X amount over the asking price and all of these different things. Context is important with everything, right? People that saw it pulled off the market. Why was it pulled off? You need to have these conversations and understand why certain things are done so that, if you're out there as a buyer or in some cases as a seller, why things were the way they were, right? It's not necessarily, and sometimes these are just one-off stories. Sometimes it's every property's like this because of, people are pricing them low to draw in bids. But anyway, just thought I would throw it out there because I think it's interesting for people out there in the market. So,
well, it's funny, Jeb, that you say interesting. Everything is interesting right now. Like, there's not boring. There's not vanilla. There's not white bread. Like, every transaction right now is unique and different, whether that's a borrower, a seller.
Are you saying white bread's boring?
White bread's boring. White bread's boring.
I don't really eat. I've eaten wheat ever since I've become a quote unquote adult. So I rarely eat white bread, and I'll tell you, man, the times I do, it's anything but plain, Josh. Anything but plain.
No
Brings me
wheat
back to my
grain, no
childhood.
whole grain, none of that stuff.
Ooh,
none of it.
A grilled cheese sandwich on white bread. That's
grilled cheese on sourdough.
Delicious.
That's next week's question. What bread do you prefer?
Oof. That's a good question. I bread. I just prefer it all. I like it all. Caesar says, "What is your projection of interest rates for the next 1.5 years, 30-year conventional?" Josh, so this isn't a forecast show, but do you see a world in which we could be sub 5.5% in 1.5 years?
That would be the aggressive side of it. I can easily see it happening. We've gone through it before. What does that take? It takes spreads moderating to 2%, even 2 1/8, 2 1/4. So the spread between the 10-year treasury and mortgages, and like a 3% 10-year treasury. Say 3 1/4 10-year treasury and a 2 spread gets you to like 5 1/4. Do I see a world where that happens? Yeah, we've been at 3.6 a couple times in the last few years in this super high inflation environment. I think inflation is moderating. I don't think the tariffs are going to cause the huge amount of inflation. I think the one big beautiful bill did not do what it was supposed to do, which could have helped rates by decreasing treasury borrowing because there'd be less deficits going forward. But I also know that the deficits themselves, at least in the short run, take money away from productive purposes. They slow down growth, which decreases inflation and decreases interest rates. So could I see a low 5% rate? I absolutely could. Am I calling for it? No. And that's why I keep kind of talking about this sort of muddle through housing market, because anywhere from 5.5 to 6.5, there's definitely a lot more activity than there is now because people just aging into home buying, especially on the entry level. But affordability is still constrained even at a 5.5% rate, which would be kind of the low end of my base case between now and the end of 26.
And you know what better way to end, Josh, than on a positive note? Mina, $5 super chat. So thank you, Mina. Just comes in and says, I've been offline enjoying my home that you all helped me buy, but I still think of you guys. Honestly, like that's the best comment. I don't know what better way to end the show. We appreciate you. We appreciate the support. Thank you for dropping in, letting us know. For those of you who are listening and watching, if you gained any knowledge at all tonight, make sure you hit the thumbs up. Consider subscribing to the show if you haven't already. Make sure you check out the Educated Home Buyer podcast. It's Josh and I's version of a podcast where we talk about all things housing in a more in-depth process. Don't answer questions, just kind of go through and deep dive into a topic and really just help educate the entire thing. But anyway, Josh is here commenting as I'm commenting on my behalf, by the way, but I appreciate you. But until next week, guys, make sure you buy right, borrow smart, and build wealth. Have a happy 4th of July. Adios.
Amigos.